After dominating headlines from an initial short squeeze, Gamestop has been headed back up lately. How high will it go, and is now a good time for you to invest? Let's get into it. Welcome back to the Hourglass Trader, where as time passes, we make money. Alright, so here we've got the GameStop 1-year chart showing, as you can see, it traded in a super low range for the longest time, with the low of about, 257 back on around April 6th of 2020, so just under a year ago. Came up a little bit to about 18, which objectively going from 257 to 18 is a pretty big jump, but of course that really pales in comparison to the short squeeze that we saw back in the end of January when it peaked at $483, but it fell back down to about 40 and 50. But recently, again, if we pull up the 20-day chart here, it's gone back to this level that it was trading around, and about 38.50 was the low point. Between that and about 50 is where it was trading. And then on February 24th, it spiked back up past 100, hitting almost $200 after hours, to where it's currently trading today around $122.69. So from here, obviously, it begs the question, since it's dominating headlines again, oh, I just missed out on it at $50 a share. Now that it's back up to 122.5, should I invest in it? Can I count on something like this happening again, where it gets up to 483, where if I bought into $122, I'd be doubling, tripling my initial investment? That's a great question. That's exactly what we're about to dive into when we talk about this video. So the way we look at it, there's really only two reasons that you would probably want to buy GameStop and be bullish on it. The first is that you believe in the company and think that their recently proposed business transformation will increase the value of the company. And the second is a short squeeze, similar to what happened just over a month ago. So obviously the first is going to be a little bit more complex of an issue, but is something that I see a lot of people saying, okay, I think the transformation is going to go well and I think the company will recover, so the stock price will go up. So let's jump into that one first and talk a little bit about the valuation of GameStop, a little bit about their transformation, and talk about whether the stock price as it trades today in the mid 120s is a good value with all that taken into mind. So first and foremost, we've got the stock up right here. As you can see, the market cap is $8.83 billion. And just to back up a little bit, when we talk about value of a company, usually the easiest thing to do for a publicly traded company is take a look at the market cap and use that as a valuation. And the market cap is calculated by shares outstanding times the stock price. So the amount of shares that they have outstanding times GameStop's stock price gets you to this valuation market cap of $8.83 billion. So let's talk a little bit about the numbers and go into their financial statements to do a little bit of analysis and see if this $8.83 billion valuation is justified. So the easiest way to do that, and we're going to show you how we find all of the financial statements, is if you go to Google and type in SEC Edgar, you'll be able to go to the company search page, which is the SEC's official filing website, and you'll be able to find all sorts of public tickers. And if you type in GME, the ticker for GameStop, you'll be able to pull that up. And the filings that we're going to want to look for are either annual reports, the 10K, or quarterly, the 10Q. And looking down the left here, 8K, which is they disclose significant events. 13G, they disclose beneficial ownership by individuals in the company. And then we'll finally get down here where we see a 10Q that was filed in December. So we're going to take a look at that. These are the quarterly financials, if you click here, for the period ending October 31st, 2020. So Q3 of 2020 for GameStop. And as you see right here, they've got a little bit of a table of contents that explains where things are. Financial statements, they're going to be first off the bat in these quarterly financials. Let's take a quick look at the balance sheet. So as we can see, we'll keep in mind, we're going to put this in the corner of the screen here, that the GameStop stock values the company at $8.83 billion. So we'll put that up in the corner of the screen to keep that as a reminder as we move through this video. So taking a look at their assets, important to keep in mind here, these are presented in millions. So 2,601 means 2.6 billion in assets. And objectively, 2.6 billion in assets, that's a pretty high number. But if we take a look a little bit further down the balance sheet, their total liabilities are 2.3 billion. And their total liabilities are pretty heavily weighted towards current liabilities, with 1.57 billion current liabilities that are coming due. And we can see big numbers under things like accounts payable, debt, and leases. So while 2.6 billion in assets is a pretty big number, as far as that ratio of current liabilities to current assets, the working capital that we like to talk about in financial statement analysis, not necessarily the strongest balance sheet in the world. And you might say, oh, this is a growth company, though. It's normal to have a bunch of debt. And in that case, you probably would have a point, but my biggest issue here really is more so about the ratio of current liabilities to long-term liabilities, like we just mentioned, that working capital. And we could definitely see them either restructuring their debt a little bit to make more of it long-term and put it off, or potentially issuing a share offering at this price to get more cash on hand to manage these liabilities, because looking at these numbers, they have 1.6 billion in current assets and 1.57 billion in current liabilities. So they essentially barely have enough current assets just to cover their current liabilities. So I think, these were for October 30th, 2020, but something's got to give with that ratio that we see right there on the balance sheet. So more importantly, though, when we talk about company valuation, are their earnings. A lot of companies are valued based on earnings multiples. So what that means is essentially you take the earnings and you multiply it by a certain number based on industry, and that gives you just a general idea of what the value of a company would be. So as we can see up here, we've got EBITDA multiples by industry, EBITDA meaning earnings before interest, taxes, depreciation, and amortization. This is information from New York University, NYU in 2019. So while things may have changed a little bit in the past couple of years, this was updated 13th of January. I don't think there was anything too significant of an update for where these multiples would not be accurate. So GameStop would fall into the category that we had highlighted a second ago, but I think went away. But they're going to be computer. Let me just Control F this real quick. Computer and electronics retailers, which come in at a multiple of 10.30. Let me highlight that again without highlighting the top half of the chart. So what does that mean? It means if you took their earnings, like we mentioned before, interest, tax, depreciation, amortization, and then multiplied it by 10.3, you'd have the value of the company. So since the current market cap of the stock is 8.83 billion, that would mean that they need net income or EBITDA of $883 million to make their current stock price justified. So let's take a look at the income statement, which is going to be presented right after the balance sheet in their 10Q. And as we can see, for the 39 weeks ended, meaning Q3 year to date in 2020, they have a net loss of $295.8 million. So not even close. Now their revenue is $3 billion, so they're at least making sales, and then the gross profit once this cost of sales is deducted is $810 million. So that's kind of close to the EBITDA you would need to justify this kind of a valuation, but once you go down another line here and see that their SG&A, their selling, general, and administrative expenses are over $1 billion, that theory kind of goes out the window. And those costs they're not really going anywhere. So on top of that, if you're looking at this, you're bullish on GameStop still, even after looking at these numbers, because you might say something like, okay, HT, they're transforming their business. A lot of those costs are going to go away. If we read a little bit further into these financials, we go down to page 24 here. Give me 1 minute to scroll through all this. This is a little bit of a breakout of the net income that we were looking at before. So you might say, okay, HT, they're transforming their business. A lot of these costs are going to go away. If we read a little bit further here, we could read exactly how much of this number in SG&A here, this 1 billion that we're looking at, is comprised of transformation expenses. So if we go down to SG&A right here, selling, general, and administrative expenses, we see that the prior year quarter and year-to-date periods included 14.4 million, so for a prior quarter, and then year-to-date 47.5 million of costs associated with transformation initiatives and severance. So if you are taking that approach of saying, okay, this is a lot of these expenses are going to be related to transformation, we could see right here that only 47.5 million of the 1 billion in SG&A expenses are related to that. So that's less than 5%. And the point being here is that when you look at the numbers, their current valuation isn't remotely sustainable. As we mentioned, they would need net income of 883 million just to match up on a multiple basis with this market cap of 8.83 billion. And I mean, I think it's okay to think that, GameStop will do well once they complete their transformation. And I personally share that opinion. Objectively, I think their business will do better if they begin to replace their brick and mortar model with an online e-commerce model. However, let's say they do well, increase sales, decrease expenses, and then end up making 800 million next year. For starters, that'd be a pretty big turnaround. But again, like we mentioned with this concepts of multiples and valuations, even with the 10x multiple, that sticks you right back where we were in the first place at today's stock price of mid 120s. So long story short, you shouldn't really be buying the stock with the theory that, it's a good value since the company should improve, the stock price should improve. But now let's jump back to the beginning. We had another bull thesis. Let's take a look at the impact of a potential short squeeze on GameStop. So to kick things off, what is a short squeeze? A short squeeze occurs when a stock jumps sharply higher, forcing traders who had bet that its price would fall to buy it in order to prevent even greater losses. This creates upward pressure on the stock. For a quick example, let's say you shorted a stock while it was trading at $10 a share. All of a sudden, it jumps up to $12. That's a 20% loss for you, and technically, there's no limit to how high a stock can go, so your losses when shorting a stock are infinite. To prevent a larger loss, you buy the shares back for $12 to close your position. But you're not the only one that this happened to. Say tons of other people were shorting this stock, and they all try to buy back at $12 a share to close their position. All this buying pushes the stock price even higher as more and more short sellers are forced to close their positions to prevent further losses. This can push a stock insanely high in a short period of time. So at a high level, that's how a short squeeze works, and that's exactly what happened with GameStop. So could this happen again? I think the answer is absolutely. Now, there's a lot of different factors that go into a short squeeze, but something I think is really interesting that sums it up pretty well is a website called isthesqueezesquoze.com. And as we can see on here, as of Tuesday, March 2nd, the squeeze has not been squoze. And obviously that's, kind of some funny tagline to show you at a high level what's going on here. But if we look at the actual detail, what's going on with a short squeeze situation? So short interest is 17 million, which represents the amount of shares that people are shorting, which in our example would be the amount of people who are shorting the stock at $10 for our example. And then the borrow rate as provided by Interactive Brokers is 3.1%. And when you short a stock, you're borrowing shares to do so. And that's just the interest that you have to pay on those shares. And then the other thing that we haven't really talked about yet is the available shares. So there's 58,177 shares available to be shorted. And typically, if you're trying to short a stock and need to buy back shares and there are no available shares, that is what drives the price up higher than anything else, a lack of available shares. So the lack of availability on the GameStop shares plays a big part in the potential for a pretty big squeeze here. So with that in mind, like we said, it absolutely could happen again. And there's not really a limit as to how high GameStop could go. Obviously, it went to $513 the first time around here. But I mean, if this happens again, it could touch 1,000. I mean, anyone who tells you they know how high GameStop is going to go, quite frankly, they're just full of shit. And because if they actually knew, they'd be rich. Instead, it's best to be informed to know that this is definitely a possibility. And really, it's just kind of foolish to try to put a number on it, but know rather that something like this, as far as the setup is concerned right now, can potentially happen in the future. I will say, however, that I don't believe it's a remotely likely possibility, and let's tell you why. And we might have been on the path to 1,000 last time until several brokers, as we could see here, restricted trading on the stock. That's something that's entirely out of our control, and no amount of analysis can account for something like this. And when it comes down to it, I think that a potential squeeze with the amount of money that's involved here might just be too big of a move to be allowed to naturally happen, and we could see the same type of regulatory risk if it runs back up again. The other thing I want to talk about is the debt situation that we talked about a little bit earlier in the video. Since they have a lot of obligations coming due in the short term, one solution for them would be to take advantage of the crazy stock price and issue additional shares to raise capital. And again, going back to the balance sheet here, this would increase the equity, which they only currently have 332 million of equity right now. But that would also consequently increase the cash on hand, so the assets that they could then use to pay down the debt that's due and decrease this number right here, which is something we mentioned earlier in the video from a fundamental standpoint that we were a little bit concerned about. One of the big catalysts that we talked about a second ago for a squeeze is lack of available shares to trade, which we could see right here again. If they did issue a pretty large share offering in order to raise some cash, this number would get a lot bigger, and the likelihood of this level of a short squeeze would pretty much go away. And now that is a little bit of speculation on that part, but one thing that leads me to believe that a share issuance may be coming is related to the corporate action of essentially pushing the CFO out about a week ago. If I had to speculate, he was probably against issuing new shares when GameStop first popped, and now that he's gone, they could take advantage of an increased share price on this second go around right here. And with that, that's all we've got for this one. Could GameStop run up? Sure, but it's not a great long-term hold at this price, and you would need to be buying the stock with a short squeeze thesis that, due to the factors we mentioned are out of our control, make it unlikely to occur. For me, the risk to reward ratio is just not there right now with GameStop at this price, and I would stay away. Thanks for watching, and be sure to subscribe to our channel if you haven't already. We just recently joined Twitch and hope to live stream stock analysis a few times a week, so we'd love it if you could tune into that. Additionally, our Discord is free to join and is a great resource to help you get ahead in the market. Until next time, this has been the Hourglass Trader, where as time passes, we make money.